Walk us through this. Should the markets be pricing in more of an inflation uptick in the near future?
Absolutely, Kriti. If you look at Treasury front-end rates of late, they've been sending us a crucial message. What is that message? They're saying essentially, look, the Fed may not be able to cut rates as set out in its dot plot. If you look at the two-year rate, it is barely 10 basis points lower than the Fed's effective rate of 4.33. So that is highly unusual in a policy this deep, this late into a policy loosening cycle, because if traders truly believe that the Fed will be able to cut, the two-year rate will be a lot lower and the spread more deeply negative, since the markets are nothing if not a discounting mechanism of what is to come. When the spread approached zero or turned positive in previous loosening cycles, the Fed had to terminate its rate cuts within about 6 to 8 months. So the markets are essentially saying that, look, with core PCE still closer to 3% than 2%, and given the outlook for stickier inflation, especially in light of tariffs, traders are doubting whether the Fed will be able to shoehorn those rate cuts as intended, which is why I think it's not a good idea for the markets, the overnight index swap section of the markets, to be pricing in oodles of rate cuts from here.
And then if I could take you to the impact of European politics on markets today, how big a risk is this confidence vote in Prime Minister Bayrou for French bonds when you've seen notes rallying into it?
Not a very big risk, Lizzy. There are signs that Bayrou's government may survive the no-confidence vote. If he does survive, French bonds will rally by only about another 5 to 6 basis points, since much of the optimism is already priced into the markets. If the government falls, then we will go back to the 80 basis point spread over Germany that prevailed through much of last year. Remember that Moody's already downgraded France in December, and they have factored in a materially weaker public finances over the next 3 years. So it's not the end of the road for bondholders, even if the government falls today. We have been in a political kind of limbo for the past 6 months, and that is very much factored into the equation of bond investors.
Vane, can I just take you back to the issue of tariffs and inflation and where we judge the market to be correct on its inflation outlook? Should I be looking at the bond market? Should I be looking at the shape of the curve to tell me what the bond market thinks is happening in terms of the tariffs and therefore by extension the impact on inflation? Or do break-evens give me a better steer? Where should I be looking? Where are you looking for the best read on how the market is perceiving that tariff/inflation risk?
I would look much more at the flattening of the curve, because the two-year yield is going to discount the Fed pricing out the rates. So I think that the two-year yield is going to go higher, and therefore we are going to get a flattening of the yield curve.